we're on the room basically from 10 o'clock in the morning till usually about 5 or 6 o'clock at night. So we're usually on for a good 8 or 9 hours, and usually it's relatively tech-free in terms of problems, gremlin-free. So I don't suppose it's too much of a hassle. It's a Friday afternoon, for God's sake. I mean, most people want to get up the road anyway, right? So we'll promise not to try and keep you too long. It is a Friday. It is a hot Friday for most people, so we'll try and get you in and get you out as quickly as possible. But I wanted to touch on some of the trades for today. We've started each session looking back at some of the things you could have had if you were obviously looking at what we're looking at. And we call this the VEX trade. Well, we don't really call it the VEX trade. It's just a term, isn't it? So it's called the RGL. It's a key strike. The VEX basically just stands for volatility extension. And you can see that we have a major, so when you look at the key levels, there's always the M and the double M levels. So if you look at the numbers there, you'll see that there's an M and a double M level. The double M level is basically 42 handle on the S&P, and you'll see that the M level is 42.12, 42.14 on the S&P. So obviously what you're looking at in the charts is those areas. And if you actually look at those areas and you start wondering about what actually happened and when did it happen and blah blah blah, how did you get on with those levels? Basically, these are areas where we should see a volatility expansion from. In other words, if the price goes above these areas, you should be trying to buy it. That's why it's called an RGL. There's no surprise, there's no secret to the word RGL. It's just basically a red-green level. How good is that? How technical is that, guys? Wow, real insight, right? But it is insight. It's green above, red below. In other words, the market makers, the dealers, would look at the markets in terms of, I want to be long because the price is generally, as a rule, above these areas, so they're trying to build a long inventory for obvious reasons. If the market's going to go up, the dealers would rather be long inventory, otherwise they're going to be wrong inventory, aren't they? Imagine the price rallying like this, and the market makers are selling passively to the buyers who are driving the market higher. If they don't have a long inventory position as this takes place, they're going to lose a lot of money. So when you think about it, remember the market maker model for the market makers themselves is that if the price is coming into an area, if the price is starting to rally into an area, the market maker model would suggest that the market maker will come in and sell some. And then at higher prices, they'll have to sell some more because people are buying it, right? People are buying and they're selling. So the market maker model is that the price is going higher and the price is going higher. The market maker is getting shorter and shorter in terms of position sizing. So if the market maker was selling 100 contracts here on average, if the market maker was selling 100 and then the next price higher, they were selling another 100 and the next price higher and the next price, by the time they reach this price here, the market maker is potentially 600 contracts short. Now remember, the price is going up and they potentially are 600 contracts short. They're losing a fortune. Now obviously their job is to try and at some stage aggregate the price, and by aggregating the price they basically just go in and they'll smash the price on the offer, try to keep the price from rising any further, and they try and drive the price down a little bit by selling some more, perhaps even quite aggressively selling some more, pulling away buy-side liquidity and trying to get the price down to a point where they can basically average out, which is basically what you look at when you're looking at your VWAP, which we introduced you to on the Wednesday. So obviously the average price on this is where the dealer would be able to make a break-even trade. And we'll actually show you a little bit of an insight on Max to show you where some of these areas are. It's called the mitigation price. And the mitigation price, if you're short 600, of course, is going to be right here, isn't it? Or 500 contracts, whatever. The mitigation price is going to be somewhere about here. And at that point there, the market maker can clear their whole inventory, assuming they can get the volume, of course. The market maker can clear their whole inventory and basically make a small profit, perhaps even a small loss if they need to do that. And they can get away from the risk of the markets continuing higher. Now, this is obviously very, very interesting if the market maker hasn't got any position. But one of the things that we've been able to establish in looking at the structure of the markets is that the market maker prior to this happening is knowing that the price is going to go higher. because the market's in above the green zone. The market is expecting the algorithms to be buying, which are the momentum algorithms, remember. So that's the guy that's on the opposite side of the market maker most of the time, is the HFTs, the momentum algorithms from the major banks. So if the market maker knows what they're going to be doing, and they do, because they know how the HFTs work, just like we do, then obviously the market maker has an opportunity to start building a position perhaps in this area here, where they can maybe build a, let's say, for argument's sake, let's say they build a 1,000 net long inventory. They build 1,000 net long inventory. So when the price is now rising, they're basically just doing what you or I would be doing. They'd be selling from their long position to lock in profits instead of wrapping up massive amounts of losses. Now, they can't always do this for very obvious reasons. They can't always do this because they would have to find 1,000 sellers in that box area to buy from. So that's something that we can understand. And what the market maker a lot of the time does is, if there's plenty of sellers coming in, the market maker will obviously have a very, very straightforward strategy. The market maker will let the price go lower, and they'll buy from them, and they'll let the price go lower from the sellers, and they'll buy from them. They'll let the price go lower, and they'll buy from them, and then they'll wrap the price back up again. But sometimes there aren't 1,000 sellers. Sometimes there isn't enough selling business to come in for the market makers to get that 1,000 long position. So sometimes they've actually got to cross the spreads themselves. So sometimes you'll find a market that does the exact opposite. The price comes away from a bottom edge like this, and it develops in this area here, a lot further away from the low price. And obviously what happens is that at this stage here, the market maker is actually buying effectively on the uptick to try and achieve their 1,000 long positions for the market to move higher. Now, obviously, we can understand this model. Whatever's going to happen, we would expect the market maker to move the market higher. Now, that doesn't mean it will. It means it's likely to happen. It doesn't mean it will happen. But whilst the market's in this location, this is the model that is going to be in operation. That's got to be useful information, surely, to goodness. That's got to be something that you look at and say, well, if I know that we can eliminate almost entirely the sell side, I should be able to make a lot of money on the buy side, joining the market maker in any kind of discount strategy, or potentially in a spring before the market breaks higher, or joining the HFTs as we get into a driving market to the upside. Now, excitingly enough, we know where these levels are located. If you look at the various boxes that we have on the screens here, we had the double M level, which is 41994202. We had the M level, which was 4214 and 4212. And we also had the RGL, the main RGL, 4209, 4211, the main RGL of the day. Red below, green above. So obviously this was sent out last night after classes and everything else is out the way. I'm obviously still sending out some of these tweets. You can see the time that this tweet was sent. It was 1:30 in the morning, 1:30 this morning in the overnight session, way before the price actually broke north. So you can see that you actually had a chance, several chances actually, to buy 4212 as the market broke north of the 4211 RGL and the 4212 major dealer strike. Now, when we're talking about the dealer strike, we're talking about the dealers in the option market who are buying to hedge a position or selling to hedge a position or unwind a position at certain prices. 4212 was a major options dealer strike price, which we want to make sure we are long if it's above and it starts catching a bid. We want to make sure we're in it. Or if it's below that level, we would imagine that the dealer would be net short, selling away from that level perhaps as a hedge protection. Now you can see what's happened to the trade today. Just simply this one trade. The market's gone above 4212. It's carried on going. It's carried on going. And as we speak right now, it's trading at 4272. It's went up 60 points. It's went up 60 points, guys. Now, obviously, as the markets went up to a high price of 72, and we can see that the buy came in at At 12s, 60 points is $3,000 per contract. Per contract during this one phase of buying above this level. Now obviously, as I said, this is only one strategy. We've obviously done some numbers for the last 5 weeks where we looked at oil prices and it's done over $100,000 in 5 weeks using this strategy alone. Now you don't have to wait till 1 o'clock in the morning to receive my tweet to know where RGLs are. There are RGLs dotted around the chart every day. In fact, some RGLs we don't know about until they become RGLs. But when we start to recognize some of these ideas, we simply can start to recognize the massive trade opportunities that RGLs bring. These are areas where we get a compression of price and an explosion of volatility following it, or what we hope is going to be an explosion of volatility following it. You may be saying, well, that's obviously pure lucky. Well, it's not really, because if the market had sold off below 42.08, we'd have been in a short trade, and perhaps we'd have been sitting with a $3,000 profit on the short side as the market sold off. Being able to eliminate that buy side below that price is an incredibly powerful element to anyone's trading arsenal. Was it just the S&P that we had a $3,000 winner today on? Well, let's stop a second and let's look at today's oil RGL. Oh yes, we have an oil RGL as well. Let's take a look at today's oil RGL. What do you make of this one? The tweet was at 9:46 London time this morning. You see that from the top right-hand corner, 9:46 AM, that's London time. You'll see that we have what we call the oil inventory number. No, it's not the EIA or private inventories number. It's not that. It's a daily number that we calculate and we put on the screens. So we have an oil inventory number today of 94.25, 94.45. Okay? No requotes, no repaints, no deletions and repainting the number so that it looks good afterwards. Oh no, none of that stuff. Now what happened obviously at 11 o'clock this morning, you can see obviously 2 hours, well make it an hour and a half perhaps, an hour and a half after the tweet, the price drops below $94.25. You see that? Look at the time on the bottom left-hand side. You'll see the timestamp. You'll see the date stamp. You'll see that this is all tying in properly. This is not hindsight, looking backwards and say, oh, by the way, did you know you had a good sell price at this level? This is telling you in advance, this is a level you want to be paying very close attention to. 94.25, but it's not just the level that I want you to pay attention to. Look at what happens when the price gets through this level. Remember what we're talking about here. We're talking about a volatility expansion trade. We're talking about markets having a volatility expansion. In other words, we're not expecting it to rotate, we're expecting it to expand, we're expecting it to quicken up. Take a look at what happened as the price got through this 94.25 level. You can see that in this area here at 20 past 11, we got this almighty rip to the downside after we were already short. And obviously it was the break of the 94 handle that brought that rip to the downside into the markets, wasn't it? So perhaps the dealers were all selling oil as the market ripped away from this area. And obviously you can see what's happened since then. We went from $94.20 to $91.20. We made $3,000 maximum swing. Guys, all we're quoting here is the maximum swings. Don't get your knickers in a twist if you start thinking, yeah, but you've top ticked it and bottom ticked it. That's not realistic. Who gives a Castlemaine? It's about knowing that you're sell side only, and therefore working short orders. If you could make $3,000 on that whole move, you're a rotten trader, because you've had a dozen or so pullback opportunities to add in and take out and add in and take out and add in and take out. 3,000 is the minimum you would be making per contract, never mind the maximum. So that's something you'd be able to look at and say, right, I get it. Look at all those opportunities to sell on springs. If anybody knows a spring, we talked about it in class the other day about trying to find some maybe level 2 liquidity, some commercial trading. Look at that sell up in these areas here. Look at that sell in this area here that you could have been working on for a transition sell into that phase. That trade there was worth $2,000. That first trade there was worth $1,600. That's $3,600 on just those two sells per contract. So you can see it's not impossible, it's actually very possible. And you can see there on this pullback here, there was a level 2 sell, and on this pullback here, there was a level 2 sell. There was another level 2 sell in there. You could have had some sells there, you could have another sell there, you could have another sell there, you could have had a sell in that area. Massive profits, right? You're probably now talking in excess of about $5,000. But this is only from 11 o'clock this morning, London time. This isn't overnight. This isn't the Asia Pacific session. This is from 11 o'clock London time through till about 1500 hours London time. This is a period of just 4 hours. 4 hours for $5,000 odd per contract. What? What's what? $5,000 per contract in 4 hours. By sticking to your narrative about right-hand edge, one-side only narratives, by sticking to that idea of trying to eliminate one side of the trade, you're starting to see the amazing ability of trading. Now, as I said in the earlier classrooms, the ability to eliminate one side, which is through structure or through value, or through structure and value preferably, gives us some incredible opportunities. And we can see this actually inside the world of Max as well, which obviously I want to just touch on very briefly today for people who are going to be in the classroom going forward, because I want to introduce it to the idea to people, because we've been watching some Max trades as well. So this idea of trading one side and one side only, you're about to look at this trade here. Now this is Max on an S&P chart from this afternoon, this evening. You can see the time, you can see the date stamp. You'll see the heavy lines, which are the Max trades. There's a buy trade, a sell trade, and several other buy trades. But one of the things that you probably don't see is the add-in trades. Now, we haven't introduced this to anybody yet because we're obviously still working on it. But one of the add-in trades is you can see that if the shaded area is in the top of the box, which it is, all the add-in trades are going to be buys. In other words, we eliminate entirely the sell add-ins, In other words, we need a very good storyline to sell the market when the shaded area is in the top of the box. Do you see what I'm talking about, the shaded area? You'll see the bottom of the box is a little bit light in terms of shade. It's just the shade, the grey shaded area. So in other words, when I see the grey shaded area, I am a buyer on pullbacks. So if I'm going to be a buyer in pullbacks, I want to show you where the buy in pullbacks is. There's a specific max we use for buying on pullbacks. It's this column here. It's this column here. Now, when you go across here, you can see that what we're looking for is basically a green circle. You might be saying, but there's no arrow in that one. There's a very simple reason why there's no arrow in that one. It's because it has to be in concert with one other green circle. It can't be on its own. In other words, there's got to be two or more. So obviously there's two green circles there, and there's two arrows there. We're buying the pullback here. Price rallied. We can see that that is a very, very straightforward storyline. There's a green circle there. There's more than one green circle there. And again, the price rallied. Now, this was a max buy. It wasn't a green circle buy. This was a max buy, so that's a normal max buy in the direction of the trend. So that's a very, very strong buy trade. It's a very strong buy trade. Look at that, guys. The drawdown on that trade was almost zero. You literally would have a one-tick drawdown in that trade. Now, the exciting thing is that I'd left this up for about half an hour on the screens, and people were watching it. And we had something like 4 trades during that period, and 4 trades went on to make some relatively straightforward cash. Not big money, but straightforward profits into break-even type narratives. Now take a look as we go across here. You can see that there is a max sell, but that's a passive sell because we are in a buy trend. So we know that this phase here, the red phase, that is going to be a passive sell. Now, I don't really like getting into a short position, but if everything else lines up, if we get some other ideas, if we get some order flow that we could tie into this narrative, we could take that short trade to get net short. But we're early perhaps to the party. And we're always going to be early to the party on the fades. Now you can see what happened since then. There is no green circles. Well, there's a green circle there. That is an add-in buy trade on the S&P, and that corresponds to that arrow right there. That corresponds to that price right there. These come in at the close of the candle. So at the close of the candle, you would be able to start bidding one bid on a limit order book, one buy market order. One buy on the limit order, one buy in the market order to try and get into 2 contracts perhaps at that stage. If you didn't get filled on your limit, you'll definitely be filled on your market, and sure enough, the price goes straight up. You make some easy money, right? You make some easy money. You can see we get a full max signal here, but we don't really get too many dots. So whilst you could have sold it, you could have seen that there was a sell trade in there. Again, it's a very passive sell, so I'm not going to sell it. I'm not going to do any market order selling, none at all. I'm going to be very passive. If I'm going to sell it, I'm going to sell with limit orders above the market, not at the market. I'm going to sell above the market, maybe 3 or 4 ticks above the current price, and that gives me a bit of room to just breathe, a little bit of room to try and assess whether I like the trade or don't like the trade going forwards. You can see what happens. The next trade we get is actually this one here. We see that there's a max add-in trade. It's a green circle, and we get another green circle to make it 2 green circles, right? This is in a bullish market, so you'll be able to see that those green circles is at the close of that red candle. These do not repaint. That's where your next buy trade would be, guys. Now you may be looking at this saying, come on to grips, guys. You're buying at 55 3/4, and by the high is 58s. You're talking about 8 ticks. Yeah, we're talking about 8 ticks. We're talking about 8 tick winners with almost 0 drawdown within literally 2 or 3 minutes as a scalp trade. Max is scalping the market here. You can see the next trade. Very clearly, you can see that there is a series of green dots resulting in an add-in buy trade here. Guess where? Oh yes, it's the end of the red candle. It's right there. Drawdown? No ticks at all. A 0 drawdown again. So this trade had a 2 tick drawdown maximum if you include the spread. This trade had 0 ticks drawdown, perhaps 1 tick if you include the spread. And this had a 1 tick drawdown if you include the spread. Buy trade profit, buy trade profit, buy trade profit. And then you can see the next trade was here, 42.56. You can see the next trade was 42.56. There's the add-in there. You can see there's a green dot at the top giving you the confidence that this is good enough. And you can see that the drawdown in this trade was approximately 1 single tick. Perhaps 2 ticks with a spread. And you can see that that buy trade at 56 1/4. Well, you can see what happened to price. I mean, we're trading 76 at the moment, guys. We're trading 76 at the moment. So if you'd been accumulating in this phase here, knowing that the whole max narrative was dominated by the bullish side of the market narrative, so that gives us an idea that the one side that we want to try and eliminate is the sell side. There's so many add-in opportunities on these. It's almost embarrassing that we never lost a single one of them. If we were using a 3 tick or a 4 tick stop, we never lost a single one of these trades if we used a hard stop of 3 or 4 ticks with a hard target of 3 or 4 ticks and a stop at break even. Now, that's pretty good. That's pretty good in anybody's world. Now, this is pretty close to finished. We had another session last night which never finished until 2 o'clock this morning. So it was a very late night trying to get stuff organized and trying to get it up to date and stuff like that. But the guys have been able to watch it for periods of time in the class, whilst we've obviously been doing classrooms, which means we've had to take it back off again and talk about some things that are happening on some of the other markets like oil and bonds or Forex or what have you. Now, there's also another exercise we did. Now, I want to ask you a question about a trade, and I want you to tell me if you think it's any good. The trade was on oil, and I want you to tell me if you think it was a good trade. What do you think of that buy trade on oil? Would you be happy with that buy trade? Do you think that's probably, if you looked at that chart from 1540 to 1650, and you said to yourself, my God, you've bottom ticked the oil price. You've literally bottom ticked the oil price. Is that not the best trade on the planet? Nobody else could have had a better trade than that, could they? It's impossible because the price went up from that arrow. It never went down from that arrow, not even once. It went up from that arrow. Now, the exciting thing about that trade, and if you agree with me, if you don't agree with me, you're an idiot, right? So you might as well just admit it and just disappear. This is a great trade in a great location. Now, what's so good about that trade is what? Guess what's so good about that trade? That trade was accomplished without using any price charts. As in, we didn't look at the oil price to get that trade. The guys in the room will confirm to you that we didn't have the price of oil on the screens when that trade took place. We weren't looking at oil prices. Oh no. And we were basically reading the market live without looking at oil prices. And I said to the guys when it was happening live, I says, right, we're getting ready for what looks like it's going to be a stop run. I'm expecting to see a large surge in volume. If we get a large surge in volume, that is the trade we're going to be looking for a buy trade. And obviously, is the trade we're going to be looking for a buy trade. And obviously what happened was that the price dropped. We got a large surge in volume, as expected. And we got a buy trade without looking at price charts. You may be saying, how's that even possible? Well, because we don't really need price charts, to be perfectly honest. Once you understand the markets, once you understand how the markets behave, price charts aren't really that important to you. So all these courses, all these indicators, all these ideas of price action trading, pattern trading, stochastics, RSIs, MACDs, and Fibonacci's and Elliott's, and all these kind of things are all actually relatively irrelevant to the marketplace. If you don't like that, I'm sorry, this is not the classroom for you, because this is the real market classroom. You might be saying, what do you mean? How is that? How is this the real market? Well, I'll ask you another question. How many charts did the floor traders during their day on the floor have access to? Did you see them looking at their charts on the floor of the CME, NYMEX, or any other pit? Did you see them suddenly stopping all the business and saying, hold on a second, guys, there's a double top coming up. Hold on a second, guys. I'm thinking about starting to buy some S&P here because I've got an oversold stochastic. I haven't seen it, and I've been around for 40 years. In other words, professionals don't use this stuff. They use this stuff to explain to retail traders or retail public how the market's behaving and how the market's dealing. But they don't use this stuff. Not on the day-to-day, point-to-point trade narratives. And this is something that you start to learn as something you can do. We've done classes on this before where we basically took a blank chart, literally almost a blank chart, and we traded gold with nothing on it. Literally an empty chart. We traded gold and we still made money with an empty chart. It's crazy. You might think it's impossible, but when obviously you're in the classroom, you'll see that it's more than possible, and it happens every single day of the week. Happens more than every single day of the week. This was a live trade call with no price charts, and that trade went for $1,000 to the upside. Whether you'd hold it for $1,000, I don't care. That's not my point. But it went from $91.70 to $92.70 for $1,000 without access to a price chart. When we understand this idea, we start to think about that this is possible. You can see that all these tricks of the trade, all these head and shoulders and double tops and double bottoms are sent really to confuse you, to try and give you patterns that you feel comfortable with, to try and give you situations that make you feel really at home. Yes, I like this idea. We've had two bounces off the same price and it's getting stronger and stronger for that reason, or whatever stupid, dumbass idea you get from this concept that two touches makes it stronger than one touch. What the hell? I've never heard so much bollocks in my life. And yet that's what's being fed to the retail public. Day in, day out, 2 touches instead of 1, and if it breaks a trend line, it's changed this and it's changed that, and yeah, whatever. So, saying, I thought we've just been doing all the stuff we've been doing this week is about price action. Yep, but it's not about angled lines and Fibonacci's. The floor traders used price action. They used levels on the back of their tickets. They remembered that there was a big Goldman seller at 46. So they remembered there was a Goldman seller at 46. And when the price is trading 45, they see Goldman's coming out and offering 46 again. The locals will come in and say 45 offered, 45, 45 offered, 44 offered, 43 offered. Goldman's comes in, sells 42s. The level is a good level, but not because it was there before, but because Goldman's did the same as what they did the last time. Regardless of whether it was at 45, 46, 47, or 49, they still came in that area. So these are incredibly important elements. We've shown you a S&P trade from yesterday. We showed you an S&P trade that we tweeted out pretty much yesterday that traded $3,000 per contract today. We've shown you an oil trade that we showed with a tweet 2 hours before it broke south. They went on to make $3,000 as well. We've shown you the max add-ins, which do not repaint, so they're all real, and every single one of those trades made a profit or a break-even scratch, worst case. And there, I think, how many arrows? 1, 2, 3, 4, 5, 6, 7, 8, 9. There was 10 arrows on that max trade. 10 arrows on that max trade, guys. And there was 10 winners. 10 arrows on the max trade. 10 winners over a period of about 1 hour, 20 minutes. 10 winners out of 10 with at least a scratch at break even. This is possible. It's not a secret. It is possible to become that good if you obviously understand and know how to deal, how to execute, how to transition your trading, and that's what we're going to be looking at today. Okay, so we said we would look at the S&P again. We're obviously focused more on the S&P narratives. And the idea, of course, is you get started somewhere. You've got to get started somewhere. And we like to draw in toxic order flow. We like to draw in key levels. We like to start the day with something on our screens. So what have you got on your screens? We told you we would be starting with the S&P. If you've been in here for the last few days, I'm assuming you've got your key levels on your screens ready to do today's classroom. Otherwise, you've not made your bed this morning and you're already lagging behind the normal traders. We told you that this is what we would look at. So when we look at the charts, we can see this is yesterday's screens coming into this morning's trade session. Yesterday's. Now, why is yesterday's important to us? Well, yesterday's are important to us because they give us some key references. The key reference we get, of course, is the day high, day low in terms of structure. The day high, we've got the day low price just there. We've also got the Asia session high, the Asia session low. So we always mark off these ideas as well. So we can see that the 7 o'clock start kind of kicks in here. So we've got that price there. And we've also got this price here. So there's your overnight session highs, your overnight session lows as well, included on the screens. Now, what else would you want to pay attention to here? Well, in yesterday's classroom, we talked about toxic order flow. Toxic order flow can be seen in hindsight by price action traders. Now, one of the things that the guys learned about today was that we are the order blocks. We don't see the order blocks, we create the order blocks. In other words, we don't live in the shadow of the smart money. We are the smart money. In other words, we create the conditions for the order blocks. You've already seen that, for example, on the oil charts, didn't you? You saw on the oil charts that we were the sellers of that higher price that then resulted in the big candle break to the downside. We were already short. If you're trading in the retail space, they'll say, oh, look at that big order block. Let's draw a line against that price into the future because that's a really important price for you to remember about. We're already in it. We're not waiting for price to trade back to it. We're in it and we're making money. Nobody else is, but we are. And that's important, isn't it? It's got to be important. Because guess what happened to that oil trade? Nothing. It never traded back to that order block. So when we look back at the oil volatility expansion trade, we were already in this trade. Now, interestingly enough, we weren't in it just as it broke south. We were actually in it up here. We were actually in the order block at the beginning of the top of the chart. And then if you did wait for the break to the downside, you would have basically have created that box there, correct? So you can obviously see that we're in it before that order block, but everybody that trades price action does what? Everybody that trades price action now does, okay, there's a selling order block, let's draw a line against that sell order block, and they draw a line. Well, the price never trades anywhere near that line, so that line's as much use as a chocolate ashtray or an inflatable dartboard. So we can see that this idea of drawing order blocks is a great concept to make sure you do it, because they're very, very important. But there's many times they simply don't trade. What we try and teach is to be the order block. Be the guy that creates the order block. Be the guy that presses home the big advantage, that creates the toxic order flow. Not the guy that reacts to the toxic order flow like retail traders. The guy that creates the toxic order flow. So you can see that we created the toxic order flow by selling below an inventory level that you already knew about at 9:46 this morning. 2 hours before the toxic sell came in. It's kind of crazy when you think about it. We are the toxic order flow. We are that player. So when we draw the toxic order flow on the charts, it is still an important aspect to be doing. So we can see that there's a couple of levels that we definitely would want to pay attention to. One would imagine you can all agree with the levels. So the first level you'd have been doing from the previous day coming into London, for example, would be which price? Well, we obviously have to do this work because we want to bring our charts up to date. There was obviously a fast money sell with follow through from this area here. So that would be your toxic order flow, yes? So that would be a sell bearish order block, right? So this would be a bearish order. That's a bullish order block you do. So we're going to go to a bearish order block. There it is. So we've got a bearish order block at that price. You can see it. It's got a fast candle response, and the price sells away from that price level. Is this a bearish order block here? Yes, it is. It breaks structure to the downside. It's a fast candle with a fast candle response. So this is also a bearish order block, which we project across on our charts as well. Bearish order block. Are you seeing anything yet? I'm assuming everybody's got these levels because we'd suggested that you want to do these things before you came into today's classroom so you were up to date. We said we'd be doing the same thing again tomorrow on the S&P to bring you up to date with it. So I hope you use the opportunity to catch up and bring yourself up to date on this. Now obviously when we can see what's happened since then, we can see that these two levels have already resulted in possibly some great trade opportunities. We can see that there was a possible sell in this area here in the overnight session. We can see that there was a possible sell up here on the retest. There was a failed top right-hand hold here, which is a very, very exciting top right-hand hold, which means we get the volatility break here. When that volatility breaks north, what's just happened? Well, we ended up with a bullish order block on this red candle, didn't we? A bullish order block here. Agreed? Well, if you're agreeing with this, if you're agreeing with this process so far, you can see that the London session has been almost a piece of cake. You can see that obviously when we got the next trade you'd have been looking at was the possibility of selling off this bearish order block. The next trade you could have been looking at was, of course, the buy off this bullish order block here. And you're starting to recognize some pretty obvious, stuff. These are great levels. These are great levels. Now, the other thing you'll probably also be able to recognize is that this is developing into a very strong market structure. You can see that if I was to measure the bottom blue line here against the top blue line here, and if I was to measure that as a local would do, and you can draw that measure on the charts, one of the things you'll be able to see is that the measured move, not a Fibonacci, but the measured move on this would take me to a sell price roughly about there. I wonder if that would have given me a bit of confluence to perhaps give me a little bit of confidence to sell the bloody 37 print. A measured move at exactly the same price as a bearish order block. In other words, a commercial sell area where we suddenly realize that all the HFTs are probably also going to be selling. And that's not a small trade. That 37 traded a low price of nearly 17s, guys. That's $1,000 sell-off right there from a massive confluence area. You don't have to take my word for it, guys. If you did your charts and you brought them up to date, you'd have probably looked at it and went, oh my God. Look at these areas pinging off the charts. Look at the incredible quality of some of these trade storylines. And obviously, as we start to develop this now as a possible bullish market, we already had given you the bullish ideas from the previous tweets, and then we extend this range from the bottom to the top. We can start to recognize perhaps some confluence areas up here. We start thinking about there's a possible sell in these areas, there's a possible reverse, possible. The truth of the matter is it's not we sell this area. We don't. We reassess things in these areas. We look for new information. We look to try and find other ideas around these price areas. We're not just automatically selling. We're asking a question. We're asking for a very, very straightforward question. Hopefully we'll get a very straightforward answer. Hopefully the markets will come to our rescue and tell us some stuff that we're trying to find out. And obviously from that we can see a couple of other things. We can see a couple of other elements starting to show up on the screens, can't we? Well, let's take a look at, for example, what Max was doing when we came into this confluence area here at 12 o'clock. Let's see what Max was thinking about this confluence area. Take a look for yourself. Max was buying on the way down. This was too big a pin. We're about to wait until the chart's on the screens. Max was buying on the way down, but it was a massive pin on this, and I said to the guys at the time, I says, that's too risky a trade. Well, let's leave it and let's wait for the price to retest. We got a retest right there. You can see Max came in, bought the retest at exactly 42.20s. At exactly 42.20s, Max bought the retest. Couldn't make it up. You couldn't make it up. So we can see that Max was helping us out with that particular trade entry, that particular trade process. We can see that it's not surprising, it's not unusual. It happens all the time. It's one of those things that when you start getting used to it, when you start to see it on a regular basis, you simply start recognizing some crazy good opportunities. So for example, coming into the bearish order block at approximately 9:30, one of the things you'll be able to recognize coming in at 9:30 is that there was an opportunity to maybe have another look. No, it's not 9:30. What time was it? 9:35 and 9:40? 9:35, 9:40, yeah? Take a look at what Max was doing at 9:35, 9:40. Take a look for yourself. It's not me that's showing you guys. I mean, it's just their live charts. What was happening at 9:40? We had a Max sell, followed by a Max sell, followed by a Max sell. We had 3 Max sells in a row. We had 3 Max sells in a row at 9:40 at a price of 42.37. A price of 42.37, the very price that was the measured move of the previous bracket area. Coincidence? No. It's not coincidence. It's by design. It's a higher order of chaos. Chaos is a higher order. It's just you think it looks like chaos. It looks random. There's nothing random about it, guys. It's all about adjustments. It's all about micro adjustments in the marketplace. We teach all of this stuff. This isn't stuff that you think, well, wait a second, there's only one person that knows this stuff. I mean, that's what we teach. Every day we teach it. Every day we go back over it. Every day we ask people to find these ideas, to develop out this thought process. Every day we're asking people to recognize the opportunities and get involved in these as narratives. Every day is another challenge. And let's see what happened next. Well, this is what happened next. The price came off this bullish order block, came off this bearish order block, straddled backwards and forwards several times at the US cash open, sell side above, buy side there. And remember, something else that you should be remembering about is what? Something else that you should be remembering about at this stage of the day. Your wholesale price levels. We're at 14s and 12s and 9s and 11s. Your wholesale price levels are bullish. The market is above the green zone. The market is green. So our automatic feeling is that that's what the market makers will know. That's what the market makers will be thinking. That's what the market makers will be doing. And therefore, we should be more inclined to be trying to buy into this than sell into this. Great news, right? So obviously, if we buy off the 21s, we make a structure break, and we're off and running. And when we come up into our target price, we maybe take a little bit of profit at our target price just here. We maybe close off our positions entirely, and we walk away. Now, obviously, you might be saying, okay, but let's go back a step now. Let's take it a step back. All of this stuff is fantastic. You called this trade all in advance. We've seen the times. We've seen the time-stamped tickets from Twitter. We've seen that this was all called in advance, traded on the right-hand edge. We get it. We understand that. But how can I see this opportunity? Purely from an order flow and a structural point of view. Well, that's what we're here to look at. So let's take it off the 15-minute. Now, why do we start at the 15 minutes? Because you need to have some of these levels on your screens before you go down into the lower time frames. It's far easier to do this work on the right-hand edge if you're using a higher time frame of analysis, 15-minute charts, 5-minute charts, even 30-minute charts to find some key ideas and key references. And then we go down into the 1-minute chart. Let's get rid of some of this noise. I won't take away all the lines because we spent some time drawing in the lines. We'll get rid of them. So let's see what happens from the US cash open. Let's just get into the idea of market structures and how we can understand market structures and how you could trade these ideas if you were literally to take just simply a systematic entry to structure and process. Hopefully this will answer some of the questions about would this have been a buy trade here or would this have been a sell trade there. When we come into a market, the first thing we've got to do is we've got to look to the left. Why do we look to the left? Because we need to know where liquidity pockets are located. That's the point of structure, right? If I look to the left, everybody will realize that very simply, without any real interpretation, we all know that the structure is bullish. We can see quite clearly that the structure is bullish. Now, there's a challenge to that bullish structure. What is it? We know where the top edge is at the moment, don't we? That's the challenge to the bullish structure. We know that the bullish structure has got a top edge around about that 37, 38 print today. We know that that's going to be a big challenge. We know that we're going to have to really work hard to get ourselves through that price. So we don't want to be too close to it, but yet structure suggests we should be almost buying right into that price area. But let's start just drilling down a little bit and start thinking about where we could maybe get in a little bit more aggressively before we hit that structure. We know we would prefer to be bullish, so that's another aspect to our trading, right? So think about what we do know. Think about what we actually have. Think about what we've actually got at this stage, guys. We know that the overall structure is bullish coming into the day. We know that we are in the green zone. Now, why do we say this green zone? Well, because if you think about it, if you're on the floor of the exchange, what have you got surrounding you? You've got walls of numbers, right? If you've never been on the floor of the exchange, you might have you've maybe seen a video of back in the good old days of floor trading. Surrounding the floor, there's walls of numbers, and the numbers represent other markets. They represent the previous day's markets. They represent the numbers that we are going to be referencing coming into today's markets in some cases. They'll have yesterday's high, yesterday's low, yesterday's close. They'll tell me whether the market's basically in profit above the close or losing money against the close from yesterday. It'll tell me if it's above and it's making money. Well, the algorithms will know that. They'll predominantly want to be buying So we already know that this is a bullish green marketplace. So we would rather be buying this. So if we'd rather be buying this, one of the key aspects to buying anything is to find starting point, find perhaps some level 2 buy side liquidity. So coming into the cash market open, where's the cash market open? The cash market open is, of course, right here. So the first thing I look at is when I look in the background, I try and find some liquidity. I want to be long the S&P. I want to be buying into this if I can. Now, this is a wee bit different from what I said we would do. I said we'd look at structure, but we'll do that in a second because I want to just deal with what we did do rather than what you would do if you were purely trading structure. So one of the things you can see is that there is there is a very nice, very aggressive ping price right there. And you just draw a line across the charts. Literally, just draw a line across the charts. And what does that do? Well, remember what we said is if the market breaks below that and immediately goes back above it, it creates a level 2. And a level 2 suggests that this is probably commercial buying. Commercial buying in a bullish market in the green zone. Well, that wouldn't be surprising, would it? And when we draw a box, what else do? We draw a line from the bottom of the box because we're expecting another box, right? So I draw a line from the bottom of the box across my charts, and I'm expecting another box. And when the price drives through this area here, I draw another box because what happened? The price immediately rejected that lower price and immediately went back above again. So what do I do now? I draw another line below the bottom of the box just there. So now I'm starting to create some very obvious level 2 liquidities. And obviously what's happening here is that we've got a chance to trade other ideas. We've got a chance in a level 2 rejection to trade a tipping price or a Heisman trade or a Bsg squeeze. Now the Bsg squeeze is what we've been talking about recently because that's the easiest and quickest one to find. So if this was a level 2 buyer here, the first trade that you'd be able to look at if you were using this idea of one side only, is the previous sell side fractal. Where's the previous sell side fractal? Well, the previous sell side fractal is right there, correct? So the worst price you could take is to buy the break of that price. That would be the worst trade you could take in terms of a buy trade, is to buy one tick above that line. That's called the interns exercise. They're taught to take that trade. Now, obviously, as you start to learn and understand this, we've said to the guys many times in the past, what price would you actually take? You wouldn't take it one tick above, you'd take it 2 ticks below the level. And that's what we call the Bsg squeeze. Now, you just don't take a trade 2 ticks below a level. When you get a Bsg squeeze, what you actually do is you look at the market, and if you're using order flow, you look for a withdrawal of liquidity coming into that price area. So obviously coming into that price area, you're looking for a withdrawal of liquidity. So instead of getting a price, instead of trying to bid 34 in terms of a market stop order, you're actually bidding, say, for example, you're bidding 33 1/4. So your actual buy trade would be 33 1/4. Right there, that's called a Bsg squeeze. That's where your buy trade is, literally, that price. The takeaway from that trade was 33 1/4. With a high price of 39 3/4, you made 6 points. Congratulations, you've just made your first $300, and it took you 60 seconds to make it. Your first $300. Now, the challenge, of course, is that you're buying right into that very, very dangerous looking overhead supply level that's obviously sticking around. So when the price sticks on this and it starts selling off, you simply look at it and say, okay, take your monies, take some profits, clear out your trade. And anyway, in the background, you'd have already recognized that there was another key level here. Now into that key level, some people might say, well, is that not also an interns buy trade here? Yes, it is. And if you were going to take an interns buy trade there, you would be 2 ticks below that price as well. So you'd pay 35 3/4 for a buy trade. You'd pay 35 3/4 for a buy trade there. That's another Bsg squeeze. But why would you not take that buy trade? Because you're in the middle of a level. You're in the middle of a level that you've already highlighted as a real problem for you, right? So why the hell would you buy into a problem, guys? My God. It reminds me of my ex-wife. I knew I was buying into a problem the day I married her, you know what I mean? So you don't want to be doing that. If you can at all avoid it. Now, it might creep up on you and surprise you. She did many times in the middle of the night with a knife, but that's a different story. So obviously you want to make sure you avoid these things. Just don't buy into trouble. Avoid it. So what happens? You make some money, price comes back down again, runs back down to the bottom edge. Now, it doesn't give us a level 2. It doesn't give us a tap back into this area here. You might argue that there was a bullish order block we could have played here, but there was no liquidity gain from that trade. This wasn't particularly a strong, successful auction to the top side. So a pullback, yeah, it's good, but it's not great, is it? It's good, but it's not great. Now, obviously, if we could enlist the help of somebody like Max to tell us that there was a brilliant opportunity to buy massive amounts of equities in that area, then we would obviously be delighted to take Max's advice on the matter. But obviously, that's only if you've got somebody as absolutely nailed perfectly as Max on the job in that area around about 1435. Now, obviously, the good news was that there was opportunities to get involved in that trade. There was actually some max triggers in that area that we could have taken advantage of. Anyway, no worry about that. The price breaks south. And obviously, we've now got this bottom edge. We already know about this bottom edge. We now know about this liquidity here. The price breaks south. The price turns back up again. And remember, if you want to try and trade these without fading these, the first thing you could do, of course, and the same as with this one, when the price breaks south and it turns back up, your first trade could be a buy stop one tick inside the value here, guys. That is a perfectly valid buy trade right there. It's called the Heisman entry. Perfectly valid to take that trade if you don't like fading on the limit order book. So obviously the same trade would be valid for this one. The price breaks south here, bounces back up, and if it goes back above value there, you can see that that is a perfectly valid Heisman entry right there. So sure enough, with a perfectly valid Heisman entry at a price of 25.5, the price rallied up to 32 as you made yourself 7 points. Another $350. Congratulations, you're doing pretty good for yourself so far this morning. You've traded the first half hour of the S&P so far, and you're doing some pretty good money. The price trades back down again. We don't get a Heisman, but obviously now we get a failed auction on the way down, don't we? We get a failed auction. Now, you might be saying, yeah, but with a failed auction up here as well. Yeah, come on, guys, waking up. Why am I not even bothering to mention this? I hope it's pretty straightforward why I didn't mention this buy trade here. Because it's not a bloody buy trade, that's why. Look at the dumbass price you would be paying for a buy trade at that price. Stupid, right? Now, if you hadn't done your work, if you hadn't obviously identified this key level, you might have been taking that buy trade, in which case you absolutely get mauled by that sell that came in following it. But because you already know this is a problem child, you just avoid them, right? You just avoid them. You pass them off to somebody else. Just say, no thanks, mate. I'm not interested. So what happens? Well, you can see what happens. We get another opportunity with a little fractal ledge right there. We get another opportunity to take another punt on this. So the breakout trade is at 1.5. Your buy entry would therefore be at 1s. So there's your buy entry right there, just before she goes. There's your buy entry right there. Does it do okay? Sure does. It goes from the price of 1s to a high price of 3 3/4. You've made yourself another $100 plus a bit of change, and you're in good shape. Now, one of the things I've told the guys in the room about trading these types of ideas when you're in these areas, if you don't like this idea of when do I put my stops in at break even, don't put your stops at break even. Don't have such a thing as a break even stop. What I also teach is that one of the things you can do to avoid getting stopped out at break even all the time is make sure that you trade multiple contracts. Why would that be important? Well, if you think about it, if I've just bought in this area here, and I've bought at 30, when the price goes up and I say, you know what, I'm going to take some 33s, I'm going to take $100 off that trade, and I take 8 ticks out of this. I can now afford to put my stops at somewhere around about the 29. And I wouldn't lose money on 2 contracts, would I? I'd basically break even on 2 contracts at that stage. So I could put a hard stop at 29.25, and on the basis that I've just taken out $100, I could use an $87.50 stop, couldn't I? On my second trade, in which case, on 2 contracts, I've just made myself $12.50, minus 2 commissions. In other words, basically a break-even trade. It's the trade, it's not the contracts that's a break-even, guys. It's the whole trade. 2 buys is 1 trade. I buy areas as a trade. I don't buy individual contracts, I buy areas. So therefore, putting a hard stop at 29 allows you to a little bit of breathing space. It allows you to take a look to see if you want to add again back into this trade on the way back up again. Go back up to 2 contracts and try it again. In other words, buy 1 again on the way back up again. And what happens? The price never stops out at 29, turns back up, and possibly, if you still like the trade, gives you another buy trade. And it gets you into a buy trade just here at a price of 31 again. And on this occasion, obviously, it breaks through the top edge, and you maybe say, right, book me some profits again. There's a classic location to book some profits into. And you book some of your money. The price fails, comes back up. I ain't going to buy this price, guys. That's madness. That's madness. I want a little bit of space. I would rather buy above this price or below this price. I just don't want to buy this price area. Now, interestingly enough, you'll be able to see that we get an inside market level too, don't we? You can see that if I draw some fractals off the bottom edges, there was a little bottom ledge just there. And following that, there was a little bottom ledge just there. And you can see those little bottom ledge was where my buying came in, right? So you can see we ran that bottom ledge, came straight back up inside that value, and you say to yourself, there's a level 2 buy trade right there, assuming you're trading this as one side buyer, right? There it is. So where's your buy trade? The top of the box, 1 tick above the box. You'd get another Heisman buy trade, 1 tick above the box there. And what do you do next? Hopefully what you do next is you draw a line against that price, because there's another possible level 2 buy trade at that point. What happens next? The price goes up, okay? Makes a wee bit of money? Sure. Scratches you back out at break even, perhaps. Stops you out for a +1 on the 2 trade contracts that you've just got, perhaps, depending upon how you managed it, right? But what is this now? You already know what this is. It's another level 2 buy opportunity, isn't it? So when you get a box and you draw a line and you get a break through that box and it goes back above, it's another box, right? So there's your next buy trade just there. You've just bought 2 more contracts. If you had get stopped out at +$12, you've just bought 2 more contracts at 28.75. You're long 2 contracts, 28.75 again. What happens? What a trade. What a bloody trade. You can see what happens. The price manages to make its move, explodes through the top edge, which is great news for us, obviously. It manages to explode through this. We've got 2 contracts in the market. You may be saying, but why are you holding the 2 contracts? Why would you not take 1 off? Do you see where the buy trade's coming from? It's not a bottom edge trade. This is what we call a top right-hand hold. This is like the half-back trade area. I don't want to take my 2 contracts off. I'm buying them to try and press them higher. I don't want to be as aggressive in profit take unless the value collapses in this trade. So when we take out the highs, now we take a contract out. Now we take a contract off, and you see the bigger the candle here, the more we like the profit. There it is, right there. We take 1 contract out at that stage. We leave 1 contract in to manage to see if the value is going to improve again. And our job, of course, now is to try and be in. At what price? Well, bring your chart up to date, guys. You tell me. This is an S&P 1-minute chart, US cash open, coming into the London close, the US New York lunchtime session. What's the next trade, obviously, setting up on that chart? Well, there is only 1 trade that's very obvious, and that is the interns buy trade at a price of 43.5, correct? Now, obviously, if you're catching up with your charts, we can see that there's a couple of things that you may have decided to mark on your screens. You may have decided, for example, that this little sell resulted in 2 very fast candles. So you might be quite accurately looking at that and saying to yourself, you know what, I think that I could mark this as a bullish order block. Remember, it's an opinion. It's not in stone. You can always adjust if you think otherwise, but there's a bullish order block, so that's giving you something to consider if the price were to trade back into that area. Remember, you're long the market, you're doing some pretty good business, you're making 100% profit so far. Every trade's been a winning trade using a very simple systematic process of level 2 buying at the Heisman and, of course, Bsg squeezes. Every single trade has been a winner. We've had 1, 2, 3, 4, 5, 6, possibly 7 trades so far, and they've all been able to get a winning trade out of them. 7 trades out of 7 trades. So what happens next? Let's see what happens next. The price pulls down into this area. It doesn't trade the bullish order block, but it does run a level 2 liquidity. Does everybody see it? Remember, liquidity means 2 to the left on a pivot. So what we're looking at is a little pivot price that came in from this green candle here. There was a little pivot price there. The price went below that. It might be very difficult to see on my charts, but if you're doing the exercises, which you should be doing, you'll see it in your own charts. So in other words, we could have drawn this as a level 2, couldn't we? And if we draw it as a level 2, what else does that give us? It gives us a Heisman entry. And if we get a Heisman entry, we can obviously now take that trade there as a 36.75 as a buy trade at 37 evens. And there's another buy trade right there for a Heisman entry. Now, one of the trades we haven't talked about is what we call the tipping price. What is the tipping price? What is the tipping price? And I want to go back actually because I've actually missed a trade, but we'll come back to that in a second. It's not a structural trade in the normal true sense, but it is a very easy to see structure. You've probably already spotted it yourself. What is the tipping price? The tipping price is a standard, simple basic arithmetic. And that is, they're inside of a structure. So for example, if I look at the simple arithmetic of a market move, and I see a price going up and I see a price coming back down, at what stage in this structure, on average, do the buyers start becoming more profitable than the net sellers? When the buyers start becoming more profitable than the net sellers, that's the tipping price. Because obviously there's more sellers that are going to puke than buyers now. So that's going to be the tipping price. So we obviously, if we can understand where that is, we could obviously use that to try and join the trade. Well, if you're looking at it from a simple arithmetic, if every price had the same number of contracts on it from an arithmetic theoretical point of view, it would obviously be somewhere about here, wouldn't it? It would be somewhere about here that the majority of buyers become more profitable than the majority of sellers. So the price would trade up to that. That's the tipping price buy trade right there. That would be the BSG buy price right there. That would be the interns buy trade right there, if the price trades there. Now, sometimes what you find is that this area is also very similar to something like the POC of the bracket area. So we can obviously understand the POC. Now, other things that you might find is that you get a little ledge in price action. So if the price is coming up, for example, here, and the price trades down, and you're sitting there saying, there's the tipping price here or here, and the price comes up and it starts doing this, you can simply recognize that there's a little ledge here, which you could even use a micro interns exercise and just say, you know what, if it takes out that price, that's my tipping buy. It takes out, I don't have to wait for the POC, because that's going to be building a POC in that area. So as soon as the price goes above this by 1 tick, I'm in it long and the price goes up. That's called the tipping price, or the TP. So we've got a lot of ways to enter this buy trade, haven't we? We've got a bottom edge level 2. We've got a Heisman trade entry. We've got a tipping price, and we've got a Bsg squeeze. So this is obviously what we call the fade. So this is the level 2 fade trade here. We've got the Heisman entry. We could probably all agree that we've got a tipping price. There's a few pins in here at that price area there. So you could probably all agree with me that that looks like a tipping price buy trade. And obviously we now have the high price, so we know exactly where to put the Bsg squeeze. The high price is 43.5. The Bsg squeeze will be 43 evens or thereabouts, right? So 43 evens, 42.75, 43 evens. There's your Bsg squeeze. Now all of a sudden you can see that we've had potentially 4 trades. You might say there's only 3 there. That's because the Heisman and the bottom edge level 2 are pretty much the same arrow. The Heisman would be here. The bottom edge fade would be just below the Heisman, then the tipping price, which comes in as we break that ledge, and then of course the Bsg squeeze, and then your profit take. So you've got 4 ways of entering this rally here. Possibly you take all 4. That would be a bonus. My God, you'd make a lot of money if you take all 4 trades, guys. My goodness, you would make a fortune. That's called pressing a trade. Now, Charlie D, if you've had a chance to watch the video, and we suggested that for this free classroom that you go away and watch the video as part of the classroom. It's 2 hours long. And Charlie D actually makes mention of something very, very important. He says, how do you tell when you're a successful trader? And the answer that Charlie D gives is that you add to winners. You don't add to losers, you add to winners. Well, what's happening during that level 2 Heisman tipping price Bsg trade? You're adding to winners at higher prices, aren't you? You're getting bigger and bigger size with profits. With profits, you're getting bigger size with profits. 4 trades back to the previous top edge. You're already got 4 trades on, and that gives you a lot of scope for flexibility. What happens in terms of taking profits, about when to take profits, about how to manage some open positions, and you could obviously just manage to do what's called a moonshot. Just let the ball roll. Let the ball roll. Run an average break-even stop on the 4 trades in total. Make a fortune if you get a good breaking market. Make nothing if the market doesn't break. You simply break even. But if the market breaks, guys, you make a fortune. So there's your choice. Make a fortune or break even. So some people don't like that because they prefer to make consistent small gains. And that's a choice. It's a personal choice. There isn't a right or a wrong answer. Let's see what happens. So now we're at lunchtime London. Let's see what happens, guys. Structure's bullish. We can all agree structure's bullish. We've got a takeout of a good price area here. We can see that there's a little bit of toxic perhaps in this area. 2 fast candles to the upside with follow through. We could probably all agree that this is a definite bullish to the upside with follow through. We could probably all agree that this is a definite bullish order block in this area. So what you would be doing is probably looking at this red candle here and saying, right, I've got a bullish order block. I want to make sure I mark my charts. You're only buy side at this stage, correct? And that sits perfectly because we know that the RGL is green. We know that the major key levels are green. We know that the market structure is green. So we don't want to be looking for sales except to do that glorious thing called profit taking. We look for high volume top lines to sell into, big up candles to sell into. Now, what happens next? Well, we can see what happens next. We get a failed auction to the downside. We can see we get a failed auction to the downside. There's a lot of stuff happening here. Bearing in mind this is lunchtime, guys. We're 1600 hours. London equity markets are coming to an end at 4:30. The London VEX and the Forex markets is already in. The market's usually bound to be quiet here. The big dogs on the trading desks have all gone to lunch or have finished for the day, and it's basically the desk jockeys who are currently covering for this period on the chart. So they're told to not get themselves into trouble, to just deal with the orders as they're coming in. Don't do anything stupid, and just try and make sure you don't lose any money till the big dogs come back to the desks. So obviously what happens is we get a little bit of liquidity, a little bit of liquidity, a little bit. Remember, we're trying to be buying here. Now, none of these is a solid buy above a level. You'll probably agree with me. None of these is changing structure for me at the present moment. The big change of structure came in here. So for me at this present moment, if it helps to answer any questions, for me the break of structure just now would probably be about 36. Because none of these is a solid buy above the top line. None of them. It's all pin rejections, it's all noise, it's all garbage basically. So what does that mean? It means I'm still buying in downticks. It means I'm buying level 2s and Heismans if I can. I don't really want to press my advantage at this time of the day. I want to try and buy cheaper and better. So obviously we've got a couple of levels that we get a level 2 from. We could all argue which ones they are, but you could agree with me that there's perhaps a little level there. I get a tiny one, literally a 1-tick level 2 there. It's so small, it's almost stupid writing on the charts, but you get the basic idea. There was a 1-tick level 2 there. We had another couple of level 2s during this little flurry of activity here. And again, if we even wanted to draw it further across, draw another straight line, we get another 1-tick level 2 right there. So these would all be potential Heisman trade buys. Every one of these trades could be Heisman trade buys. We could have had another Heisman trade buy here. We could have another Heisman trade buy here. None of them are big enough to put in a tipping price, perhaps. And I don't really fancy buying a breakout because of the time of the day. See how that simple knowledge comes to the fore? Knowing that there's times to press your luck and there's times not to press your luck. Once we get past this 4 o'clock, 5 o'clock stage, I'll start pressing my luck. I'll start buying back into the Bsg squeezes. I'll start looking at value to extend my gains to the upside if I get the opportunity. But for this period, I'd rather just buy at cheaper prices and rotate out at slightly higher prices. So in terms of profit taking, just using those little breaks of level 2 liquidity just to take a little bit of money off the table. So what happens next? Price comes back down again, turns back up. We're now getting through 1700 hours. 1700 hours. London's now gone. Liquidity vanishes out of London. We're expecting to start to see the possibility that we're going to start seeing the US volatility kicking into the markets as a standalone market. Europe's closed. London's closed. It's over to you guys in New York. What are you going to do with this market? How are you going to make your weekend money so that when you go to the Hamptons, you don't have to worry about the price of a bottle of champagne, a nice bottle of Cristal, or your favorite Cuban cigar? It's time to mark up the price. So you can see, of course, that we've got a couple of little level 2 liquidity top lines. You can see we could have had a top line here, and you say, okay, a failed auction, which is good news because we've had the level 2, so I don't really want to press it from a level 2. But we get a failed auction here. A failed auction at 1658 on the downtick. So because we've got a failed auction to the downside, now what's a failed auction, guys? A failed auction is something you all know about. It's where we get a higher low in terms of structure. So we've got perhaps a high, well, we've got to first of all establish that we had a higher high phase. So in terms of market structure, we've already established that we had a higher high here. So we got a higher high here. And we had a higher low here. Now, you don't know you've got a higher low until you've got a higher low. That's why you can't just come in and buy the downtick, because that's not, unless you've got access to somebody like Max who buys the pullbacks, you're not going to know that's a higher low until it is a higher low. But obviously when it does turn and it goes back up, you have several possibilities. You've got the tipping price here and you've got a Bsg squeeze here. So you've got 2 tradable opportunities. So let's get back to the chart. So we've got 2 tradable opportunities on a failed auction. We can see that currently the level 2 buy would be below that red line on the right hand side now. So the next level 2 auction would be now below this price of 43s. The price goes below that, I can start bidding as far as a limit order bid. If the price goes below 43s and then goes back up to 43 1/4, I could put a Heisman buy stop order in place. In terms of a tipping price, I'm not sure I've got a good tipping price in here. If I do, if I was to look into this and I got a nice big volume lean for whatever reason, it's probably realistically going to be about here. If we've got a tipping price, it'd probably be about there because of the 2 candle overlap here, the 3 candle overlap, and then the break there. That's probably your tipping price. And obviously your Bsg squeeze, we know what it is. 48.5 top line. You're going to be buying the Bsg squeeze at 48s, correct? So you're going to bid 48 right there, guys. That's your buy stop, 48. There's your buy trade. Where's your target price? In all this excitement, we forgot to think about where our target price is. Well, our first target price is usually the bracket measured move. Now, if you're a very aggressive scalper and you do like to add a lot of size into these trades, basically for a BSG squeeze, what the BSG squeeze algorithms actually do is as soon as the price takes out the prior high, they start taking profits, literally. So in other words, if it takes out the prior high and we're 2 ticks below the prior high, the BSG algorithms actually take profits at +3 ticks. +3. Now that's called scalping, isn't it? You're scalping literally a few ticks out the market inside these very, very, very strong momentum-based areas. But if you're trying to swing it, of course, you've now got a low price, you've got a high price, and we can obviously simply make another measured move target price. We draw it in our charts, and we say, right, I'm going for a top line price of 55 here at the moment to take some profits, and not to take all my profits, but to take some profits. 55. So let's see what happens. Let's carry on with this process. The price comes up, the price comes back down again. We're now at 17:15. Things look good. We're starting to see some shapes forming that we could maybe exploit with a possible level 2, a possible Heisman, and a new BSG squeeze. The new BSG squeeze, of course, is obviously now we're looking at this price here at 52.25. We can see that there was a little ledge here on that red candle here. And what I'll do is I'll zoom in a little bit because it's obviously getting very tight in here. So you can see it around about 17:11 this evening, London time. 17:11. We can see there's a little red candle that has 2 upturned candles. That gives us an ability to just mark that off as a possible level 2 Heisman. So obviously that's correct because that's exactly what happens. The price goes below it. The price goes immediately back above it at a price of 49.5. You've got a buy stop order at 49.75 for a Heisman trade. So there's your buy stop order right there. The price comes up. The top line buy trade is 52.25, so you're going to buy 51.75, right? You're going to buy 51.75s. Now, disappointing for your BSG squeeze is you probably get filled there, and it drew down against you a little bit here. Okay, so what? You're in a buy trade at the bottom edge. You've already possibly taken some money off that trade anyway. You've got stops way off the bottom edge in terms of a break even. And you're in a trade, and now it breaks higher. And you simply take a little bit of profit. Come back in and you say, thank you very much. I'm going to take another little bit of profit. Remember, you've got a target price here of about 55s. The second thing you're starting to recognize is we've managed to take out the 42.50 level. Now, obviously, 42.50 is a relatively big wholesale price for S&P, isn't it? The S&P, the Americans love their quarters, their halves, their 3/4 and their zeros. They love these quarters and eighths and all these kind of numbers. They still do. They don't like the metric system. So we've obviously got to pay attention to this idea that 42.5 or 52.5 or 50s and all of these prices are relatively important. The bigger the round number, the bigger the importance. So 42.50 is the second most important level as opposed to 42 evens or 43 evens, right? So this is a big level for us. So holding above this is actually quite a big deal. Okay, let's see what happens next. We have a couple of clues. This market's now broken and holding above the top edge. So you may well now decide at that stage that your break of structure moves up from the previous level into the lowest price of the new level. And this is now your break of structure at 43s. Everybody agree with that 43 break of structure? Hopefully you're drawing it on your own charts. Hopefully your charts are up to date. Hopefully you're starting to see these very, very simple basic elements through these processes. It shouldn't be that difficult to be able to recognize some of these opportunities. Okay, let's carry on, guys. Let's carry on. Okay, we're taking ourselves up to 1750. What's happened up to 1750 this afternoon, guys? Well, we can see that the price is kind of trundled higher. It's not really done much. We haven't quite reached our top line target price. We've literally just pinned the top price here. You can see that it's not had any closes above. We're not aggressively moving our break-even structures or our reversal structures at any stage just yet. And that means something very, very significant for us. Number one, we've got a top line price. Number two, we now have a pullback price, which is now here, which means that we also have a Heisman price, which means we also have a possible tipping price, which means we have a new possible Bsg squeeze. Now, at the top edge, we also have another little ledge here. So we can try and get into the Bsg squeeze a little bit earlier, a little bit more aggressively than the top line price. That's a good thing. That's not a bad thing. That's a good thing. So obviously this top line that we've got here is at a price of 53.5. We haven't got a level 2, so that means it's a failed auction. That's good news. So we should be able to make some easy money here. So obviously at the price of 53.5, we're looking to buy this at 53s. Buy stop order at 53s. So we put our buy stop order in here at 53s at 17.36, and we're looking to now press through the top edges. Now, as I said, the algorithms, what they'll do is one tick through the top edge, they will book their profits and get the stops at break, literally their stops at break even. If that's you, that's you. If that's what you want to do, because it's an aggressive buy trade, that's what you want to do. Okay, so what happens? We get a rejection at the top edge. So you're probably thinking to yourself, I reckon we're probably going to go lower, which would be a realistic thing to consider at this stage. And the price breaks into a level 2 low. Now remember, you're not necessarily buying the break lower. You're waiting for the break lower to be bought. And then you're joining in when it does break. And obviously when the price breaks the level 2 and it trades 51s and it comes back up to 51.25, you're putting a buy stop in at 52s. And sure enough, you're off and running at 52s. And you're back in the game again. So now we've got a possible tipping price, you might agree with me. But there was obviously a couple of pins in here, which I quite like, around about the halfway stage in this area. So I quite like that price. There's a bit of space for me to get a tipping price and a Bsg. Sometimes they basically occupy the same space, accurate to 1 or 2 ticks of each other. But if we've got a little bit of space, I quite like the idea of getting my tipping trade on as well. And obviously the top line price is now at a price of 54.5. So where's our buy trade, guys? 54 evens. Our Bsg squeeze is now a buy trade at 54s. We get a buy trade at 54 right there. The disappointing thing for the algorithms and for you is you don't automatically get that fast money break to the upside and you say, bollocks. But you're in pretty good shape, right? You've got a buy off the bottom edge for a Heisman. You've got a buy tipping price at 52.75. And you've now got a top edge price of 54s. You're not going to lose money in this trade. Not a chance. So let's see what happens. Okay, it doesn't take out the highs. The price stalls and you're saying, damn it, damn it, damn it. The price sells back off and maybe you scratch that whole trade for a 0. +1. Maybe you scratch the whole trade here for a 0. 3 trades, a bottom, a middle, and a top. You're scratching that for +1. You're maybe making yourself $12.50, maybe 25 bucks. But the whole trade is maybe scratched. Okay, so now you're ready to start again. You're still bullish. We haven't had a change of structure. The change of structure is still at 43s. It hasn't changed. It hasn't changed in any way, shape, or form. So we are only bullish buy side only. We want to try and stick to the buy side because we are green. We're bullish the markets, and the structure's still bullish. So we start finding the new levels. Well, where's the new levels? Well, this was the level here. So that would be pretty obvious to have in the charts. However, we've updated that level with some new levels that have developed at this price. So we've obviously got an opportunity to start all over again. We've got a Heisman trade right there. Now I don't necessarily have a tipping price, but I could possibly draw in a Bsg squeeze right there. It's pretty tight, guys. I know it's pretty tight. But the Heisman trade is there. You're in at 52s. If you're going to take a Bsg squeeze, you're looking at a price of about 53.25. So you're about 5 ticks away from your Heisman trade. It's okay, it's not bad. So obviously you take your buy trade in here. You get a profit, it goes above the top edge, and if you're obviously still concerned that this is still early in the lunchtime session, usually the lunchtime session, 18:30, 1900 hours, that's when we start to see the real market wrapping up because the dogs are back at their desk, okay? The big dogs are back at their desk. So you know we're going to be footering about with crap here for a while. So what happens next? We get another level 2 trade right here. 1802. The price pulls back to give us another level 2 buying opportunity right there. You should be copying along with this, guys. You should be copying along so that you see what I'm saying, so that you understand that it's there in front of your own eyes, visibly, and therefore tradable. So you had a Heisman opportunity to buy right there. Now, obviously, that previous high gives us a new fractal edge that we can lean against here. There's a couple of nice pins in here for a possible tipping price rather than a Bsg squeeze. Now, if I took the tipping price at 53 and a quarter, 53 and a half, I wouldn't be taking a Bsg squeeze one tick higher, guys. That's just stupid. Too many trades all at the same price puts me into serious trouble at times. So there's my tipping price right there. What happens next, guys? What happens? What a nice takeaway from the upside. So we can see that coming into 1800 hours, the price is now broken structure. We've got a good close above structure. And we're in pretty good shape now, aren't we? We're in pretty good shape. So let's carry on. Let's catch up. So we've now got a new top edge. We've got a new pullback trade here. Now, if you want to get really aggressive at this stage, you can say to yourself, well, wait a second. There's a lot of buyers now in this area here. So I quite like the idea that this is now a break of structure. So I'm going to bring my actual structure lows from 43s. I'm going to bring them up from 43s now. And I'm going to bring that structure into a price of 51. And that would be a good idea because it would correspond to a break below 42.50 at this stage, wouldn't it? So a break below 42.50 would open up the door to possible market selling as a net short position. Gives us a bit of room. Okay, let's see what happens. Price pulls back. Price goes back up to the top edge. We get a Bsg squeeze. We take out the highs. A new structure high. We don't get a pullback. We get a failed auction. We go back in for a Bsg squeeze again here. We take out the highs. We get another 3 ticks. We get another failed auction. We come back in for another Bsg squeeze. We take out the highs. We get another 3 ticks. We get another failed auction. And the price comes back. Now, what's happening in here is we're getting new, more aggressive level 2s forming. And that's something that we should be mindful of because they're all very close to each other, which means there's a lot of stop liquidity starting to build. We call this paycheck liquidity. There's a lot of liquidity in this area between 56 and 54 that we should be very, very mindful of. Because if we're buying the structure, and you're learning the structure of the HFTs, which is what you are learning just now, all of their stops are probably starting to build at the same price area just below this 55 print. That means there could be quite a sizable drop through the 55, which we must be aware of. Let's carry on. The price takes out the first structure. We take out a high price first of all, guys, so we get another one just there, another 3 ticks, another 3 ticks. Take out the highs, and then the price breaks structure. Now remember, we're not buying when it breaks structure unless you're very confident about how to trade on the downtick. You're only buying if it goes back above the highest red line. And it does go back above the highest red line. So it trades the red line at 55.75. You're buying at 56, aren't you? You're buying at 56. And you're targeting the high price again here. The price comes up towards 56. You want to get a Bsg squeeze? Well, you want to get a Bsg squeeze. Now, the worrying thing about the Bsg squeeze is because it's came down through this area, it sometimes takes a little bit of effort to get it through the next one because we got a lower low in the microstructure, which means the sellers were relatively successful the last time. A level 2 liquidity tells me, this was level 2, that level 2 liquidity tells me that we're going to have a little bit of difficulty getting through that price, perhaps on the next swing, just like this last level 2 here, back at 1800 hours. The level 2 tells me that we're going to take a couple of attempts to get through the next high because the last seller technically was short-term successful. It's relatively straightforward logic, isn't it? So what happens next, guys? What happens next? Well, nothing much. Well, we come back into the same level. We turn back around. You may well now think that you've got enough space. You may think you've got enough space to go for a tipping price rather than a Bsg squeeze. There's your tipping price trade just there. What's going to happen? Let's see what happens. Boom. What an attack, guys. What an attack. Right up to 61. What a breakout trade. What a winner. What a winner. That's pretty impressive, guys. Now, obviously, it's up to you at this stage. If you're being very aggressive, you're going to bring up your structure change because that's now broken structure here at 58s. The lowest low between that structure is now going to be around about this 55 print. So we're going to bring the structure up at this stage to a 55 print level. We're now going to run structure off the 55s here. Yes? We're in good shape. We're in very good shape. So when we look at this as an idea and we start thinking about this as a storyline, we can see that this is pretty powerful stuff. It's not just random opportunities. It's got structure. It's got entries. It's got process. It's got objectivity. None of these trades are subjective, are they? It's a lower low, which gives us a Heisman. It's 2 ticks off the previous high, which gives us our Bsg Squeeze. These are all objective trade entries, which means that being an objective trade entry, these ideas are repeatable and scalable, and we can look back on our charts and we can verify by testing backwards that these are all great idea trades that we can use on any marketplace. So let's see what happens next. Let's just carry on going, guys. Let's carry on going. We're getting there, aren't we? We're getting there. Let's just carry on going, guys. Let's carry on going. We're getting there, aren't we? We're getting there. So there's the high price. The price comes down. The price rallies. Fails to take out the top edge. It's 1900 hours. Yes. The price fails to take out the top edge at 1900 hours. But what have we now got at the bottom edge here? We've now got a level 2 here, haven't we? We've got a new level 2. So obviously what that means is a new level 2 means a new Heisman trade. So the next Heisman trade is when the price breaks below that price at 58.5. You've got a buy trade at 58 3/4. You're buying at 58 3/4 and you're now ready to trade. Now, we now have a more aggressive Bsg Squeeze price, haven't we? Because we've got that little ledge right there. And we've got this ledge here. So we've got a very aggressive Bsg Squeeze, which looks more like, to be perfectly honest, a tipping price. It's in about that halfway stage. So we obviously can go in now just before it or just after it. 60 evens, good wholesale price. 60 evens, it's a 10. We could get in 59 halves. So if we want 59 halves, we'll try bid 59 halves, see how we get on. And there's your next buy trade, guys. The takeout to the top edge, take some money off the trade. Hey presto, things are looking good. Let's take another look. Is that good enough to move your structure? Probably not. It's a break above the top edge and it comes back inside, so it's not good enough to move structure at this stage. I'm happy to leave structure where it is. There's the new top edge just there, guys. The structure for us is bullish above 55s. Bullish above 55s. One of the things that you might be starting to recognize is how much different is this trading style? Being able to just remain on the long side, not worry about having to try and sell it, not worrying about what happens if, just simply carrying on with the process. Let's see what happens next, guys. The price pulls back. We get a couple of pin rejections, which gives us another level 2 level right here. The price then comes away from that level. And then it pins just here. Now, one of the things that you'll start recognizing at 1924, it pins at 1924. Now, this is usually a good thing because I like to see that little pin at the inside level because it gives me a more aggressive entry price to go for that Bsg squeeze. I hate getting Bsg squeezes at top edges. There's just something not natural for me in that price. It's great for the algorithms, but it's a little bit unnatural to buy into that top line, but it makes a lot of money. I just don't like it. So I prefer it. I prefer it when we get these little ledges here. So we've got 2 ledges at the top edge. This one's a little bit more aggressive at 61.25. So I could pay 61. I could pay 60 3/4 for a buy trade. And I would be looking to get into the buy trade just there. What a beautiful buy trade, isn't it? Price breaks clean out of that area and explodes north. Now, one of the things you'll probably agree with me on this occasion is that that is a clean break. It's not a rejection. It's a clean break. The price goes up beautifully. We see that lovely bit of business. We see that lovely bit of business. And obviously what's going to happen next is we've got a new structure. What does that new structure mean? That means that I can come off this price here and I can bring my structure and I can now run my structure. I've gone too far, guys. I can run my structure off of this level because that's the level that's broken because we never counted this one, remember? So that's the structure that's broken. So the lowest low of that structure is now this price here. This is now my structure low at 58s. Has everybody got that price? Does everybody see why we've got that price? Does everybody have that price? Now we're still bullish above 58s, bearish below 58s. So we can still keep focusing on the buy trade process. We can keep focusing on the buy trade, which is great news. That's what's making his money, right? So let's see what happens next, guys. Let's see what happens next. Wow, what a trade. What a fecking trade. That's a beauty, right? We've just went from 60s to 70s. We've just made ourselves another $500 per contract. Crazy, isn't it? So what happens next? We get a pullback, new bottom edge. So which means we can now mark off the top edge. This price will now become a possible reversal price, correct? But that's only if we clear 69.50. Then this becomes a possible reversal price. What happens next, guys? We come back down into this area. What does that mean? We get a level 2 buy trade here, don't we? Did you all have that price? You're supposed to be getting ahead of me on these charts, guys. That's the challenge, right? That's what your challenge is to get ahead of me on these charts. You should already have this level 2 marked off and say, yes, I had that level 2 trade. So let's see what happens. So we got a beautiful level 2 just there, which means we got a beautiful Heisman trade just there. It's the most beautiful Heisman trade you've ever seen. There's a beautiful Heisman trade right there. Price of 66 evens. We're coming up to a new pivot price in the middle here. There's a new pivot price from that top edge. Just a little bit shy, which I like, as you know. I like that. I like that. I like that a lot. That's what your chart should look like, with one exception. Should have a little line now coming off the bottom of that level 2. So we come up into the area. We're starting to get close to that price. You may well have taken a tipping price at 67s. The range is extending. That's why I quite like the tipping price. There's 2 pin candles in here. That's what I'm looking for. A little ledge at the same price that I can just put a little tipping price trade in. And I like to do that when I think I'm getting close to a top edge. The nearer I get to the top edge, the less excited I get about Bsg squeezes because I know I'm buying into trouble. So I'd rather be buying level 2s, Heismans, or tipping prices than Bsg squeezes the closer I get to a possible end of day or what I think is perhaps a measured move or something else. So let's see what happens. Oh my goodness, guys. Oh my goodness gracious. We come into the top edge. We come into the top edge. You can see that we've just absolutely killed it. Beautiful trade. If you took the Bsg squeeze, either here or here, wonderful. Price breaks and holds above the top edge. So what are we going to do with our structure price? The structure price, because that's now a break above, remember the structure price is based on the previous high and the new break high. So the break high came in here, and the lowest low price is your new structure break price. So we now have a brilliant area to put our structure break price into. Structure break comes up to this red line right there, and that's your new structure break price, 64.75. Still buy side only, aren't we? Let's see what happens next. The next level 2 trade we have is perhaps this ledge here. So that's what you're marking on the screens. You're marking that level. You're marking this level because they're the level 2s, correct? So let's see what happens. Well, nothing much. We start seeing a sell coming in there. The price hits a low price here. Comes off that, which means that you'd have been struggling, but you'd have probably have had enough room to get a Bsg squeeze in. But if you don't like it, I accept that. But if the top line was a price of 72.5 and it dropped down to a price of 70, you've got about 8 ticks there. You could get 2 ticks before the Bsg. So you'd put a Bsg squeeze in at 72 evens, and we get a beautiful break with a beautiful profit to the upside. We now have a new higher high here. You might be saying, but do we move this structure up at that stage? Well, not really, because this is really just the one move, isn't it? We haven't had any reasonable pullbacks yet, so we don't really have an ability to move up the break of structure. You can move up the break of structure if you want, by the way. It's, in this case, this is the subjective part, right? The Heisman buy is not subjective, the level 2 is not subjective, the Bsg squeeze isn't subjective, the tipping points aren't subjective. But what is subjective is, when do I move the structure? Because that's going to be dependent upon whether you believe you're getting closer and closer to a top edge, whether you believe the value is changing. If you think the value is changing, I want to get really aggressive with my break of structure. If I think the value is glorious and that we're going on forever to the upside, I want to try and keep that break of structure as far away from the break as I can realistically. So that's the subjectivity in this. So there's no real pullbacks in this, so I don't really want to move this price up yet. I'm just going to leave it at 65s. We've now got this ledge here. We've still got this ledge here. This ledge here would take us into a breaker structure, so that would be difficult to accomplish, wouldn't it? The bottom ledge, the price of 65.25, that'd be difficult to get a level 2 buy without breaking structure, so I'm not going to draw that line anymore. So now we've got a top edge. What are we going to do about it? Well, a top edge, price pulls back, turns back up. We've got the possibility of a tipping price, perhaps against the red candle, but I don't really like it. So possibly just a Bsg squeeze at 75.5, 75 quarters. So a Bsg squeeze. The good news is we've now got another level 2 to draw on our screens, which gives us another chance to get a Heisman trade. And you can see what happens. We get a break to the downside. Now we don't get a Heisman trade because the price breaks down and it doesn't turn back up again. So that's not a Heisman trade. It's not even a level 2. It now comes down to this price. It does not break structure here. And then it goes back above this price. So there's your Heisman trade right there, isn't it? This becomes a level 2 buy trade. There's your Heisman trade, and there's your target price. Now, this is a pullback. This phase here is definitely good enough for a pullback, and therefore, if the price breaks 77s and it holds a close above 77s, I would now use this price as my break of structure for selling into. So I'm going to be very, very excited to see this. I've also got a Bsg squeeze somewhere around about 76s. So the price doesn't give me my Bsg squeeze. Interesting, isn't it? We get a little stutter step, comes back out. We've obviously got a couple of key levels at almost exactly the same price here. We're watching very, very carefully. We've now got a new fractal ledge in here. Nothing's changing, guys. It just seems to be a more difficult time of the day, doesn't it? It seems to be a little bit more problematic for us to get the trade on. So we've got to be careful here, right? We've got to be very mindful of this. We've now got a new low. You might say, could we not have used this as a new low? Not really. It's one candle to the left, one candle to the right. It's not really good enough. But we've got a new low at this price. We've also got a top edge here, so we could get into a nice Bsg squeeze. So let's see what happens. The price trades back down again. It gives us 2 candles to the downside, which means I can bring in my Bsg squeeze into this area here. I've got a Bsg squeeze here. And I've got a Bsg squeeze here. So that's a good range, isn't it? That's a very nice range to do a Bsg squeeze. The lowest of the 3 lines at 74.5, so I could put in a buy trade at 74 evens. So I could obviously put a little buy trade in here at 74 evens to try and get in as early as possible for the break, if it breaks higher. Let's see what happens. It did break higher. We made some nice money, didn't we? It made some very, very pleasant little cash right there. Take some money, take some profits. You can see obviously the time of the day. We're running out of time. The day's about finished, so we've got to be taking some of this money now. Take it a little bit more aggressively. Make sure we book and bag and tag some of that money on the way. But let's bring our chart up to date, guys. Bring your chart up to date, not my chart. Bring your chart up to date. So where's your level 2s? Your level 2 is now here. Your level 2 is now here. Your level 2 is now here. And your new level 2 is now here. Now that's not a real break of structure because there's no real solid closes above here. So I'm not aggressively bringing this level up, am I? I'm just going to leave it where it is for the time being. I also mark off my new high price, which is now at 77.75. I'm going to be looking to take a Bsg squeeze at 77.25. And what happens next? We're now up to date on the right-hand edge of your charts. What happens next, guys? We break the structure high. It pins, but we take some profits if you want. It pins, comes back inside. We don't take out the low. The low is now resting at this price here. I don't know why I've moved it up to that price, but it doesn't matter. Then we've got level 2s coming out of our ears here. We then put in a new low price here. And it turns back round again. And when it turns back round, guess what? We've got a little tipping price right here, haven't we? Why is that a tipping price? 2 pins. 2 pins. So I can get in a little bit more aggressive than the Bsg squeeze back into a buy trade here. And obviously we get a nice little break. Obviously the target price is this price here, of course. So we get a nice squeeze on this one, don't we? And sure enough, there she goes. The market's just closed at 9 o'clock. Our day is now finished. We've completed the whole day. We've done all the trades, every single trade that you could have taken as a floor trader. It's been a busy day. I think you could probably all agree with that. It's been a busy, busy day. But every single trade that you could have taken as a floor trader has now been taken. All the Heismans, all the tipping prices, all the BSGs, every single one of those is a trade that you know with a very high degree of certainty, a very high degree of objectivity that you could have taken as a trader. We've never once broken structure back to the downside, assuming you agreed with all the structural elements. We've never once broken structure. So let's zoom out a little bit and see what our chart actually looks like now that we've finished the day. Now that we've actually finished our day, guys, what do you think of our chart now? Do you think you could have made some money? Do you think you could have made some money? If I'm not mistaken, I don't think we had a single losing trade. I think we probably had a couple of scratches in there somewhere. I don't think we actually had a full stop loss. And I must admit, we've taken a lot of arrows, right? And I don't know if we've overlapped some of the arrows, but let's just count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47 arrows. 47 arrows. 47 discussed, described objective trade entries. 47 objective trade entries. And what looks like approximately 47 wins or scratches during the course of that day. The market structure has been updated behind us. You can see that from the shaded area that rises like a stepping stone process. We have done that which has a level of subjectivity, I accept. We do that with a level of subjectivity because we don't know. We have the ability to disagree on whether that was enough of a break to make it a move higher. But I'm always willing to err on the cautious side until I'm really starting to get bearish, in which case I err on the aggressive side. I want to get more aggressive with the ramp up of my structure breaks. So that's where decisions can be made. You can leave it as loose as you want. You can tighten it up as much as you want. But that's about 47 winning trades. Now, I hope that you agree with majority of them. You might not agree with all of them, but I hope that you see that we used a very, very fixed structure. All the level 2s were marked on this charts. None were missed. I don't think we missed a single level 2. All the BSGs were discussed. All the previous highs were drawn on the charts. And you were always looking for that opportunity to press into those areas. Whether you take the BSGs, whether you don't take any BSGs, whether you take tipping prices, whether you take only the level 2 Heisman trades, doesn't really matter anymore, does it? But if you want to trade, you had 47 opportunities to trade in the direction of structure, the direction of sentiment, the direction of volatility, 47 times. Now, you might be looking at it saying, yeah, but 47 trades, a lot of them were very, very, very short term. Yeah, I can't disagree with that. 47 trades were very, very short term. I definitely can give you that as a takeaway. But if you just traded one contract on those 47 trades, and you were able to average 4 ticks, and we saw that we could certainly make 3 ticks and a scratch on most trades, but some trades went a lot further than 3 or 4 ticks, you'd have made $2,300 today on a single contract, scalping the market. Now you might be saying, but 47 commissions, my God. Okay, 47 commissions, $3 per trade in commission. It's cost you $150 off of your $2,350. And you've ended up with a very, very substantial $2,200 profit for the day after commissions. Think about it. Is this an unusual day? Yes, it is. What's unusual about it? It goes up, and it just goes up, and it just keeps going up. Do these days sometimes happen? Yes, they do. Now just imagine for a second, imagine you're big enough in terms of your account size that you could have pressed these trades instead of taking all your profits out and starting again and taking all your profits out and starting again every time a 3-tick or a 4-tick gain. Imagine you were able to hold on to 1 or 2 contracts and build and build and build and build into a moonshot trade using the profits of the previous legs to build some more. Potentially have ended up with 5, 10, 15, 20 long positions, making thousands of dollars, tens of thousands of dollars potentially, by the time you reach the top edge. That's the world of institutional algorithmic trading. Just on the odd occasion, every now and then, we get these massive moves. Now, when you stop a second and you think about it, and you start saying to yourself, yeah, but does it often happen? Did we know we were going to get a move above this level? Well, we remind you what we started with in today's classroom. We started today's classroom with this idea that we had already given you the RGL price of 42.09 from a tweet at 1 o'clock this morning. We'd already told you that you should be predominantly trying to work buy side only above a price of 42.09, 42.11. So you already had insight to have potentially have started this process for yourself. You would have been looking for level 2s and Heismans. You'd have been looking for Bsg Squeeze and tipping prices, all on the buy side of the markets. You could use the 42.09s as your original break of structure price because it's read below that price anyway, and we'd have to break structure to go below that price regardless. So you could start with that narrative as you started out in your day. Was it just on the S&P that we were able to get this enormous tens of thousands of dollars in profits today using this process? Well, not really, because if you remember what we also said about oil today. So it wasn't just the S&P, was it? What we said about oil today was we gave out a thing called the inventory level. We told everybody that it's $94.25 sell side below, $94.45 buy side above. So in other words, that's your hard structure to start with. So you're not having to figure out what your structure is. You know what your structure is. It's buy side above 45, sell side below 25. Here we go. If it's below 25, sell side only. That sell dropped for $3,000 per contract. Straight line. You can see how many opportunities you may have had of taking a sell Bsg squeeze. You can see how many opportunities you would have had just by now looking at that chart. You'll see all the level 2s, can't you? Oh, I know you can. Don't tell me otherwise. You can see all those level 2 Heisman sells now, can't you? They start to ping off the charts. You start looking at it going, oh my God, this isn't good. I could have had a Heisman sell in here. I could have had a Heisman sell in here, followed by a Heisman. I could have had a Heisman sell in here. I could have had a Heisman sell in here, followed by a Heisman sell in here. And then I could have had a Heisman sell in here. And then I've definitely got a Heisman sell in here, that's for sure. And then I've got a couple of ledges here. I could have had a Heisman sell in here, a Heisman sell in here, a Heisman sell in this little ledge here, a definite Heisman sell in this area, and a massive Heisman sell reversal up here. I've got a Heisman sell in here, and I've got a Heisman sell in here. I've got a Heisman sell in here. And I could have made all of those Heisman sells, but on top of those Heisman sells, I also had a squeeze of this level here. I 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 had a squeeze of this level. I had a squeeze of this level. I had a squeeze of this big level. I had a squeeze of this level. I had a squeeze of this level here. Get the basic idea. I had a squeeze of this level here. 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 I had a squeeze of this level. I had a squeeze of this level. I had a squeeze of this level. I had a squeeze again of this level. I had a squeeze of this level. I had a squeeze of this level, and so on. Hundreds, potentially, of trade opportunities. Level 2s, tipping prices, Bsg squeezes. The possibility that you could have had 40 or 50 sell trades using the structural reversals. And obviously, when you look at the structure, you're really looking at this market and saying, but would you ever have had an aggressive structure reversal during that whole process? Probably not. Because when we broke structure here, and that created the structure reversal at this price, yes, we break lower, but we don't get any buy. We don't really get any solid selling below here. It's a single candle that reverses. So I don't think we've ever broken structure to the upside. So selling into this, I don't think has ever changed. When we broke structure here, then of course it's the same price anyway. Now when we broke structure here, I can agree that there's some selling down here, and that would have moved my structure down from here into this area here, and then my structure would now be here, and then I would have moved it down to here. Sorry, where would I move it down to? No, it'd be there, right? So I'd leave it there, and then when it breaks structure here, I'm going to be moving my structure down into this area here, and then I'm going to be running my structure based on that level. It never goes bullish on a macro structure, guys. Never goes bullish on a macro structure. Sell side only, because it's below the RGL. You want to try and hold on to the sells for as long as you possibly can do. So when we understand this and we see this as it evolves in these areas, we can start to see the power, the abilities of the simple stuff. And that doesn't include the ability that we showed you on the gold chart, which I hope a few of the guys did tell you actually happened. It's not some magical voodoo. It's just good, solid, tradable ideas. We were able to trade the gold chart without the prices, without the price charts. In other words, we were never going to be suckered by price action. We were never going to be suckered by the RSI or the stochastic giving us an oversold position. We simply traded well. I'm going to finish off at that, guys. I've done 2 hours. We said we'd try and do 1 hour. As per usual, we're a little bit behind the curve. So I am going to get out of here. I am going to say, hopefully, that you've learned something. You've been in for a week now. We've done 4 days. We've done about, in total, of about 8 hours. Hold on a second. So we've done about a total of about 8 hours trading. So we can obviously understand that we've covered a lot of different stuff. We've covered some key ideas, some key references. We've covered some basic structures. We've tried to get you to consider the idea of squeezing the market, selling the pullbacks, trying to get the level 2s, finding liquidity traps, pressing home your advantage, and probably more than any of that, we've tried to get you to think of the markets as one side only. There's many great traders that have always said that the key to success in the markets is to eliminate one side of the market. Eliminate the buy side or eliminate the sell side and focus all your attention, all your energies to being buy side or sell side only. And that's why we sometimes focus on it. People pick up on the fact that I emphasize the point in the room. Paul's a great example. He starts to use the same wordage. So I'll say things like sell side only. We double emphasize it, if you know what I mean. Sell side only. So that you realize that you should be trying to focus on the shorts, just like we did on the S&P. When we looked at the S&P today, we would be shouting loud and proud in the room, buy side only today, guys. Buy side only, unless we break structure. Unless we take the market below this rallying, stair-stepping process, it's buy side only. We're looking for level 2s. We're looking for Heismans. We're looking for tipping prices. We're looking for Bsg squeezes. We are buying and we're buying and we're pressing and we're buying some more. So hopefully you've learned something. If you like what you've heard, I'm sure Kim will give you a couple of ideas about how to go forward with us as a class. But it is a free class. It was meant to give you some ideas to get started with. If you want to use your stochastics, it gives you some better clues about how to use your stochastics. If you want to go back to your usual Elliott wave or Gann theory, guys, absolutely fine. The idea was to make you better traders, guys. No money in this as for us at all. We just wanted to try and give you something that would give you a couple of ideas to improve the way you approach the markets free gratis. So have a good one. Have a safe one. Have a great weekend. For the guys that are joining us tomorrow, classroom tomorrow is, and Kim will give you all the details, but it's 3 o'clock London time, 3 p.m. London time tomorrow for classroom, where we'll start benchmarking some of this process with some R-squared ideas on the S&P again tomorrow. So make sure that you've covered the S&P charts again today so that we can go back over this again tomorrow, and we'll start looking at some of these. We're going to be looking at some of the Forex markets like the pound, and we'll be covering some of the VEX markets for the pound, some of those volatility expansion trades that we make a lot of money on in sterling. But just do the work, guys. Try your best, be the best you can. Have a great weekend, and I will see you guys who are joining us on Saturday, and hopefully I'll see a few of you guys going into next week on Monday. Have a great one, and until then, I'm going to say adios amigos, arrivederci, auf Wiedersehen, sayonara, tutsins, tak skado, do svidania, and spasibo. In the meantime, ciao for now.